Good morning, everybody. How are you? Glad you're all here. This is terrific. I've been looking at that pizza. That's really looking good. I may have to break down eventually. I'm Ken Owen. I'm a 1982 graduate of DePauw, and I am the special advisor to the president here. And thrilled to be the person who introduces Scott Nations this morning. I guess what I'd say, because you've got the biographical information, it's counterintuitive, but sometimes when things are really tough in your life, you have some of your best experiences. I mean, you learn. The only way you grow in life is to be challenged. But it was 11 years ago this year, 2007, that the sorority that Wendi was a member of, and Wendi and I knew each other, but we weren't really friends. And the sorority had a membership review. It was not a pretty thing. You can look it up. I'm not going to get into details or even name any names, but at the end of the day, it was a national news story, and I was, and I still am, the person that does media relations for DePauw. So we were in a spotlight that was not of our creation. And Wendi, it was a time when the first day that it happened, and I'd just gotten a cell phone, I think I had 240 media calls. 240 different reporters called me. I was going crazy. And I really needed support. And Wendi reached out to me as a person who was a member of that sorority, expressing her support for our position and the work I was doing. And that meant so much to me. And so we connected as friends in a deeper way, and I got to know this guy. And so I would say to you, the next time you face a really tough day, tough week, tough month, tough challenge in your life, there's a silver lining in there, and it might come in the form of a great friend, two great friends. Wendi Taylor Nations and Scott Nations have been here since yesterday. They got to my house Sunday. We had some fun. And Sandy was telling me about the great interactions they're having with you. For those of you who've been lucky enough to meet with them, I know you've enjoyed it. For those of you who haven't, I hope you at least come up and shake their hands at the end, because they are terrific people. You see Scott on CNBC. He has a book out that is continuing to get great reviews and is extremely informative, because I'll tell you, the one final thing I'll say is, as you get to be an older guy, and I don't consider myself old yet, but I remember when I was one of you guys, you understand the importance of history. Life is history just repeating itself. Different faces, different names are on the marquee, but you can learn a lot from history. And Scott's book about stock market crashes and how they've played out is extremely informative. So with no further ado, please welcome to DePauw University, Scott Nations.
Thank you. I appreciate that. All right, thank you very much. My name is Scott Nations. I run a financial engineering firm in Chicago. I spent 25 years in the markets as an options trader. So for that entire 25 years, I was one of those crazy guys in a bright red polyester jacket. You've probably seen footage of it, jumping up and down, yelling and screaming. I did that for 25 years. It was a tremendous amount of fun. I actually started at the Chicago Board of Trade the year before the crash of 1987, which we'll talk about a little bit. Now, Ken said, Scott, would you come and talk about your book? And I thought, well, which book? Because I've written two incredibly geeky technical books about options trading, and he said, no, those are not scintillating. You cannot talk about those. So we're going to talk instead about my latest book, which is a history of the United States in 5 crashes. We're going to talk about it for one. Well, the first reason is it's scintillating. The second thing is this is a general interest history of not just the stock market crashes, but our country, what our country was like during each of what I call the 5 modern stock market crashes. So there are oversized personalities, we're going to talk about some of them, that attended every one of the crashes. Some of them fostered the crashes and were responsible for them. But again, I talk about what I call the 5 modern stock market crashes. And you're probably going to be able to ace this question given the topic. So what do these 5 years all have in common? Sure enough, each one experienced a stock market crash. Now, you're not going to remember all of them. In 2010, you may ask, well, what happened in 2010? And we'll get to that. But each of those 5 years had a stock market crash. And you know, this is not just an academic exercise. People's lives are impacted by stock market crashes to an incredible degree. And the charts here I'm going to show, they express some of the fear that is generated by stock market crashes. And people withdraw from the markets following stock market crashes. They think the world's going to end. And you know what? As an investor, it is tough to not be in the stock market. It's tough to fund your retirement. It's tough to finance your kids' educations if you're not going to participate in the stock market. But these are the 5 modern stock market crashes. We'll show the 5th one here in a second. And if you look at these, you can understand how it would be possible, almost required, for somebody to lose faith in the stock market. So the first one in the upper left is 1907. That is known as the Panic of 1907, a long time ago. 1929, probably the quintessential crash, and you can see exactly why that is called a crash. In the lower left is 1987. You guys don't remember that. Many of you, well, none of you would have been around for it. It really has defined much of modern finance in kind of particular ways. In August of 1987, the Dow Jones Industrial Average was up more than 40%. People thought, wow, the market can do no wrong. And in the span of a relatively short period of time, a number of days, it had given all that back and more. October 19th, 1987, worst day our stock market has ever had by a factor of about 2. And people just came to realize or believe that you cannot trust the stock market. Something you did live through, and in fact, really the heart of it was 10 years ago this month, was the financial crisis of 2008, 2009. And there are still people who are devastated financially by this, and the stories of all these crashes are fascinating. So the next one is what I call what everyone calls the flash crash, which was May 6th of 2010. And this is probably the least known. We'll talk about why I included it. This is a single day. This is a single day's trading. At one point, the Dow Jones Industrial Average was down 1,000 points. People thought our markets had been hacked. They didn't know what was going on, and it was devastating for many investors. They thought, if something goofy like this can happen, why am I going to put my hard-earned money into the stock market? So crashes really screw with people's thinking. There are people who lived through the crash of 1929 and then the resulting Great Depression who never trusted finance ever again. Think about that. They never trusted the stock market. They were never willing to put their money in a bank. They were never willing to put their money in a bank. So crashes have a tremendous impact on people. How so? If you had put a single dollar into the Dow Jones Industrial Average on the day that Teddy Roosevelt became president in 1901, and that's kind of the start of the American century. If you put a single dollar in there on that day, on May 7th, 2010, the day after the flash crash, your dollar would have grown to $154. That's pretty good, but that's also a long time, more than 100 years. What if you had missed a single day? What if you had been able to avoid a single day of those approximately 25,000 trading days? If you'd missed one day, October 10th, 1987, your dollar would be almost $200. So you would have gained almost an extra third if you'd missed a single day out of 25,000. What if you had missed the 5 worst days? Just 5 days out of 25,000, you would have more than doubled your money. So those 5 days had an inordinate impact on how your investments did, how you were able to fund your retirement, and how you were able to fund and finance educations. So the interesting thing, the reason I wrote the book is that all of the crashes are astonishingly similar. It was Mark Twain who said, history may not repeat itself, but it rhymes. And that's the reason I wrote the book, because they're astonishingly similar. And it's not just, oh, a lot of people not understanding what they were doing lost a lot of money. But the similarities include, this makes sense, big rally in equity prices, that is, stock prices went up a bunch. There's a Merle Haggard song, I only fall when I'm on the mountain. Well, it's tough to fall and hurt yourself if you're already in a ditch. Similarly for the stock market. If it rallies, really gets ahead of itself, that's when it can crash and really cause problems. There's an increase in interest rates. That's just kind of a function of the way markets work. When interest rates get higher, stocks are less valuable. But here are the interesting things. Every stock market crash has an external catalyst that often has zero, absolutely nothing to do with finance. Absolutely nothing to do with finance. And we'll talk about these because I think they're interesting. As an example, as the first example, the panic of 1907 was undeniably cause, the catalyst was the San Francisco earthquake of 1906. And I explained how this happens in the book. But think about it, that's a natural disaster that ended up leading to a stock market crash. But every one of the crashes has an external catalyst, often has nothing to do at all with finance. Every one of the stock market crashes is fueled by some sort of novel financial contraption. Everybody thinks it solves a problem, but these are generally untested, at least in times of stress, and they all come unspooled in really ugly ways. So we think that there's some new technology that's fantastic, it's going to solve a problem. And what happens is that when markets get stressed, these all inject some sort of leverage into the system when it can least afford it. And we'll talk about some of those. Oops. Every one of the crashes has a warning. We are warned of every one of the crashes. Sometimes we listen to the warnings and sometimes we don't. Sometimes the warnings come from charlatans, so we don't listen to them, but every one has been preceded by a warning. And the final thing we'll talk about are the heroes and villains, because the book is about the people who create, for example, the financial contraptions, but also the people who spawn some of the crashes. So every crash has a villain. Unfortunately, not everyone has a hero. But we'll talk about some of those. The interesting thing is that sometimes the hero in one crash thinks they've got it all figured out. That person thinks they have it figured out. They end up becoming the villain in the next crash. That happened twice, and it's really fascinating. So we'll talk about the external catalysts, the contraptions, call them contraptions, and some of the heroes and villains. So what are the catalysts? Well, I've already talked about the first one. The first one for the 1907 panic was the San Francisco earthquake, which had taken place the year before. And how does that become a catalyst for a stock market crash? Well, think about it. Essentially, the entire city of San Francisco had burned to the ground. Most of the damage was not done by the earthquake. It was done by the subsequent fires. Part of that was caused by the fact that at the time, if you insured your home in San Francisco, you could insure it against fire. You could not insure it against an earthquake. So guess what? Your home is damaged, almost beyond repair by the earthquake. What do? Well, if you want to collect an insurance claim, you set it on fire. And often those fires got out of control, and they burned down essentially the entire city, what remained of the city after the earthquake. So for a couple of different reasons, we need all the capital in the country, all the free money, all the money that's available in the country has to go to San Francisco for rebuilding, and that undermines the stock market. We don't realize it's going to happen until later, but that's essentially what happened. So that purely a natural disaster. In 1929, what was the catalyst? This is the only one that has anything to do with finance. Clarence Hatchery was a fraudster. There's no other way to put it. He was a fraudster. You've heard of Bernie Madoff. In some ways, Clarence Hatchery was the first Bernie Madoff. He was trying to buy a steel company. He lived in London, trying to buy a steel company. He realized, well, you know, I own some stocks, and I can pledge them for a loan to buy the steel company, but I don't have nearly enough. So what did he do? He started counterfeiting stock certificates. He started counterfeiting them and pledging these counterfeit stock certificates so he could borrow enough money. Eventually, people realized, wow, all of these stock certificates are fake. They're not worth anything. Well, what do you do if you have a stock certificate, you don't know if it's real or fake? You sell it. And so everybody who owns stocks said, I have no idea if this is an age when stock certificates were really what mattered. That was the evidence of ownership. So everybody said, I'm going to sell all the stock I own because I don't know if these stocks certificates are legitimate. So a guy running a relatively small scam in London, a month later, crashed our stock market. Worst crash the market's ever known. Worst single day the market's ever known, 1987. Dow was down 22%. People have forgotten this. The Friday before that stock market crash, the Iranian military attacked some US flagged oil tankers in the Persian Gulf. They bought a bunch of Silkworm missiles from the Chinese. They thought it made a lot of sense for them to attack some U.S. tankers. They blinded the captain and the lookout for the Sea Isle City, big tanker. They also injured a bunch of other people, about 24 other people. That's the Friday before the stock market crash of 1987. That's an act of war. Make no mistake, that is an act of war. So Ronald Reagan was president at the time, said, we are not going to take this sitting down. The Sunday before the stock market crash, we responded. We bombed the hell out of a bunch of Iranian oil platforms. So when you woke up on the morning of Monday, October 19th, you were worried about the stock market because it had performed horribly the week before. You were certain we were at war with Iran. You were absolutely certain we were at war with Iran, given everything that had happened. Now, we know that OPEC provides so much oil that people said, if we're at war with a member of OPEC, I do not want to own stocks. I want to sell them. And a few hours later, the stock market was down 22%. 2008, this is Ben Bernanke finally said what everybody in the world was thinking, we're not doing mortgages the right way. You were young at the time, but essentially it was possible for you to get a mortgage to buy a home that you could not afford, or through fraud that you really could not afford. The catalyst for really what happened in 2008, really 10 years ago this month, was Ben Bernanke, who was chairman of the Federal Reserve, finally saying out loud what we were all thinking, which was, oh my God. Now think when you're in the doctor's office and the doctor is examining you, what's the last thing you want to hear your doctor say? Oh my God. That's really what had happened. And finally, 2010, the Greek government, in fact, the Greek economy, throughout all of the previous decade, had borrowed as much money as they could. And they were cooking the books to make it appear that they could afford to borrow all this money, that their economy was in great shape. When it came out that that was not the case, people like yourselves, actually recent college graduates, said, you have just destroyed our way of life and the government is responsible. And there was literally rioting, arson, and murder in Athens, Greece on May 5th, 2010. And the next day was the flash crash because American money managers said, I don't want to own stocks. I don't know what's going to happen in Europe. So those are the catalysts. And you'll notice that they have very little to do with finance. What are the contraptions? You know, you think now, you think 401k, IRA, you think of electronic trading through your brokerage, education savings account. You think of all of those financial contraptions. At some point they were new. At some point they were new. And so the financial contraptions that came unspooled in 1907 was it was an entity called a savings trust. What could sound better? Two wonderful words, saving trust. What they really were was a savings and loan grafted onto the worst sort of risk-taking gambling hedge fund imaginable. And so everybody thought they were putting their money in something that was secure, and the money was going out the back door to finance the most ludicrous projects possible, riskiest, most ludicrous projects possible. So what happened was people started to learn about this. They said, oh my God, these guys are taking my money. They're supposed to be investing it sensibly. It's supposed to be safe. Last thing in the world. So what happens when that happens? People line up to withdraw their money. There's a run on the bank. And so savings trusts were the worst sort of combination of risk-taking grafted onto something that everybody trusted. If there's anything that would sound better than a savings trust, it would be an investment trust. Nowadays, we would call this a mutual fund or an ETF. That's a great way to invest in the stock market, except that what investment trusts did was they took your dollar and they borrowed $3 more and they put it all in the stock market. Okay, that works until the stock market goes down. But it didn't in the 1920s, it kept going up. So they said, well, why in the world are we taking $1 and borrowing 3 when we can take $1 and borrow 9 and put it all in the stock market? Stock market never goes down. We're missing out on free money. So that works until it doesn't. And then when it doesn't work, everybody has to exit the stock market all at once, all at the same time. So an investment trust, which started out, again, as a neat idea, kind of a mutual fund, became a mutual fund on steroids. And when everybody has to leave the market all at once, there are not enough buyers. There never are. If the two above portfolio insurance sound like they're wonderful ideas, what could be better than insuring your portfolio? Portfolio insurance was an idea that would use incremental trading to ensure that your portfolio of stocks would never fall below a certain value. And that sounds like a wonderful promise. My portfolio of stocks can never fall below a preset value. That sounds great. The problem is it's absolutely impossible to deliver on. It assumes a bunch of things about the way the market works that are utterly untrue. And it was created by academics. It was created by some of the smartest people in academia, in finance, in the world. The problem was they failed to realize that the markets don't work the way they assume they did. And so, again, this is another example of when the world's coming to an end and everybody wants to sell, there's never enough buyers. There are never enough buyers. There's never enough liquidity. This is probably the first one you guys are familiar with. You've probably heard about mortgage-backed securities, even if you didn't really understand what was going on in 2008. So, you know, a mortgage to the person who loans you the money to buy a house, it's a little bit like a bond, and that is they're going to get paid interest. They're going to get paid interest from you. You're going to pay interest to whoever lends you the money. And then eventually they're going to get all their principal back as well. So assuming that whoever you're lending the money to can pay it back, that makes sense. So think about putting 1 million mortgages together. What do you end up with? You end up with a giant bond. A giant bond. It's going to pay interest over time. You're going to get your money back at the end of it. You're going to get paid a really nice interest rate. That makes sense. Unless you start lending money to a bunch of people who can't pay it back. Think about that. Think about you being in this situation. You've borrowed money you can't pay back. What do? You default on your loan. And that's what happened in 2008 with mortgage-backed securities. Interest rates were so low, we'll talk about that in a second. Interest rates were so low, people were willing to take extra risk by investing in mortgages in order to get extra return. All of these things make sense until they get perverted. And mortgage-backed securities clearly got perverted. So the idea was a little bit of a good thing, let's have too much of a good thing. And finally, and this is something that will probably resonate with all of you. When I was that crazy guy jumping up and down, all trading was analog. It was all person to person. You were a buyer, I was a seller, it all happened face to face. Now, trading is all electronic, or it's almost exclusively electronic, and that's a great thing. It's much more efficient. It's much more efficient. Well, what's that mean? It means people have unleashed algorithms into electronic trading because they think, I can train the computer what to do. I can teach the computer what to do, and they can do it faster than I can do it. That's also a good thing until you lose track of what your algorithms, what the logic is. So another example of something that started out as a great thing and ended up unspooling and causing a crash. So those are the contraptions. Those are the things that people thought would solve a problem at the time and ended up creating a much worse problem. Now is where we get to talk about the people. I think it gets really interesting here because we're going to talk about personalities. You're going to have heard of some of these, you're not going to have heard of some of them, and you're going to be surprised that some of them were the villain. So who was the villain for the panic of 1907? I think it was clearly Teddy Roosevelt, the president. This is a guy who believed, his quote was, the only work worth doing is war or work that is akin to war. That is, he was a belligerent. He wanted to fight with people. He thought that was the work that mattered. And so when he became president, the only worthy people he could fight with were the wealthiest people in the world. And he decided that John Rockefeller, the wealthiest guy in the world, was going to be his target. And he started attacking these people, attacking them. And when you do that, you don't know what somebody's business is worth. And so he took it too far. He clearly took it too far. It was no longer, I'm watching out for the little guy. It's, I want to pick a fight with this big guy. So I'm certain you've all heard of the Federal Reserve. In 1929, the Federal Reserve was relatively new. Their goal was to manage interest rates. And Benjamin Strong was probably the least lucky guy of the 1920s. First wife left him with her children. Second wife shot herself. About that time, he contracted tuberculosis. All of his friends had abandoned him. So he was head of the Federal Reserve, and he wanted to get along with everybody. And the way to do that was for him to lower interest rates. When that happens, you inflate a bubble. You inflate a stock market bubble, and that's exactly what he did. And he did it essentially because he wanted to be liked. He wanted to be liked. Instead of doing the right thing, he wanted to be loved by everybody. So he inflated this giant bubble. Stock market rose to crazy heights in 1929, and there was nothing left for it to do but crash, which it did in October of 1929. Who were the villains in 1987? Corporate raiders, and I put an asterisk here because those are the guys who often get blamed for what happened in 1987. In the early 80s, the stock market was really underpriced. And some of these guys, T. Boone Pickens, Carl Icahn, are two of the names you might have heard, they realized, well, I can run in, I can buy this company up, I can break it up, I can buy it for $1 billion, I can sell the pieces off for $2.5 billion, and I get to put $1.5 billion in my pocket. So they are now blamed with running up the stock market in the 1980s. I think a guy, I'm a finance guy, I think a guy who can buy a company for $1 billion, break it up and sell it for $2.5 billion is doing what he should. I mean, if the current management can't maximize the value, then I think that they probably deserve to be thrown out of their roles. So these guys, these are the ones who get blamed for what happened in 1987. I think clearly, the villain in 2008 was Alan Greenspan, who was head of the Federal Reserve at that time. He kept rates, again, crazy low, inordinately low, sparked this huge bubble in housing prices and in stock prices. And it's not, he didn't do it because he wanted to be liked. Alan Greenspan did it because he didn't understand what was going on. He didn't understand why interest rates were so low. The economy seemed to be chugging along. It was recovering from what happened on this day in 2001, that is 9/11. It was also recovering from the tech bubble bursting. But he didn't quite understand all the dynamics. He kept interest rates way too low for way too long, fueled this massive bubble which can only deflate in a crash. The villain for the flash crash of May 6, 2010 is, I think we know the name. I don't put it in the book because we're not 1,000% certain who put it in the order. On May 5th, 2010, it really looked like the entire European Union was going to come unglued. And that would be devastating for our economy. So some guy in a leafy suburban asset management office in Overland Park, Kansas, which ironically is where I grew up, said, you know what, I want out of the stock market, and I want out of the stock market now. So over the span of 20 minutes, he sold $4 billion worth of stocks. And the market doesn't support that. You can't do it. It's like saying, I need all of you to leave the room in 5 seconds. Well, there aren't that many doors, and you can't get to them, and that's the way trading works. You can't, there's just not that much liquidity. He wildly overestimated what the market could provide as far as liquidity is concerned. He didn't care. He wanted out, and he was going to get out. And he sold more than $4 billion worth of stuff in 20 minutes. And the only way to do that is to essentially crash the stock market, although fortunately it came back much of the way that day. Okay, we've talked about the catalysts. And here is the problem that I see going forward, because everybody wants to know, when is the next crash? What's going to foster the next crash? What's the catalyst for the next crash? Think about those catalysts. Think about the time between the catalyst and each of those crashes, because this is what matters. The time between the catalyst and the ensuing crash is collapsing. From the April 6th earthquake to the crash was just more than a year. From Clarence Hatchery's fraud to the crash in 1929, that was about a month. Going to war with Iran to the October 19th, 1987 crash was a weekend. And on May 6, 2010, the catalyst had happened a day before. So as you can see, the time from the catalyst to the crash is collapsing. A year, a month, a weekend, a day. We are now in a situation, particularly with Twitter and what's going on in China, that the time between the catalyst and the crash, we might be lucky if it's an hour. What would happen to our markets if the president of China said, we own about $7 trillion worth of US debt and securities and stocks, and we're going to sell it all. We don't like what you're doing about tariffs. We don't like your president. We don't like your president calling us out. We just don't like you guys in general. We're going to sell it all, and we're going to sell it all now. The time between that news breaking and the stock market crashing, I'd be surprised if it's an hour. I would not be surprised. I'd be surprised if it's 5 minutes. I would not be surprised if it were 30 seconds. So that's the real concern. It's that the warning, the amount of warning that we get, is absolutely crashing. It's not the only thing that's crashing. So again, the book is intended to be a general interest history with lots of personalities. There are some fantastic personalities in there. I hope you'll read the book. I hope you enjoy it. It's not intended to be one of those, oh my God, you got to read it because there are lessons to be learned here. The goal is to make it fun. But make no mistake, the worst thing you can think about finance is it's different this time. Because it's not different this time. It's exactly the same. The characters will change, the speed will increase, the names will change again, the contraptions will change, but the story, as Mark Twain said, it may not repeat itself, but it will rhyme. And you guys are going to get out, you're going to start making some money, you're going to try to invest it, you're going to invest some of it in the stock market, hopefully, because it's a great way to build wealth. But crashes can do tremendous damage to your ability to finance your education, or finance your kids' education, or finance your own retirement. So that's it. I'll take any question you have. I'm happy to answer questions about this, about CNBC, about anything else. So go crazy. This is as good a chance as you're going to get. Yes?
What's your stance on some of the Obama-era regulation that they kind of put in place on a lot of the banks? Because I know it kind of prohibits them from kind of doing their job, but it also does put some measures in place to kind of protect from some of these crashes. So I guess what's your...
Good question. The question is, what about Obama? We'll call it Obama-era regulation that was spawned by what happened in 2008 and 2009. It's a good question. When people see that sort of thing happen, that sort of dislocation or a crash, the first thing they say is there ought to be a law. The Federal Reserve was created as a direct result of the panic of 1907. The Securities and Exchange Commission was created as a direct result of what happened in the 1920s. So same things like Dodd-Frank, which is really the law now that matters here. For that to happen is to be expected. The goal is for it to make sense. It doesn't all make sense. For example, there's something called the Volcker rules, named after Paul Volcker, who was, for some reason, I have a tough time saying that sometimes, former chairman of the Federal Reserve. And Volcker's idea was we should not let big banks like JP Morgan, Citibank, Wells Fargo, we should not allow them to take risk by trading for their own account. Because if it goes wrong, they're going to come to the government and say, hey, bail us out. So the first thing that happened was we're not going to allow banks like that to take risk for their own profit or loss, because they end up with the profit and the world ends up with the loss. That probably makes sense. What happens is they pass a big law, we realize parts of it are good or parts of it are bad, and they end up walking back the parts that are bad. If people are upset about some of these laws, I'm like, what did you expect? What, you have nobody to blame but yourself. What did you expect? So we'll end up with much more regulation. The stuff that's really stupid will eventually get rolled back. So, next question. Yes?
So, considering the interest rates and the current optimism in the stock market, do you think that there might be a stock market crash in like a year or two?
The question is, given the current interest rate regime, interest rates are really low, will we have another stock market crash? One of the reasons that crashes stand out in our minds is that they are actually relatively rare. So I talk about 5, and more than a year passed from the first one to the last one. So there's more than 20 years from 1907 to 1929. There's 50 years between the second and the third. There's 20 years between the third and the fourth. And there's only a couple years between the fourth and the fifth, but I'm going to address that in a second. So crashes are relatively rare. I mean, a real crash. And the definition of a crash is somewhat subjective. You know, there's no absolute definition for what constitutes a crash. What is much more likely to happen is the market will just really suck for 18 months. It will go down moderately, but it will continue to go down, and it will do that for a while. And people are just like, they'll throw up their hands, oh, I've lost a bunch of money. But it won't be some sort of cataclysmic disaster, because those are relatively rare. So when people see the roster of crashes I talk about, they think, oh yeah, 1907, I heard about that one. 1929, I heard about that one. 1987, if you're my age, you're like, I lived through that one. 2008, everybody knows about that one. 2010, why did you include that? Because that's the one that is by far least known. So people ask, why did you include that? Particularly given that the market came back quite a bit. It was down 10% at one point during the day, came back more than halfway. The reason I include the flash crash is because the next crash is not going to look anything like the panic of 1907. It's not going to look anything like what happened in 1929. It's not even going to look very much like what happened in 2008. It is going to look like some purely electronic, algorithmic trading disaster when people are actually not in the loop. Not in the loop. Because we're now in an environment where if you're a trading firm, a proprietary trading firm, trading for your own account and risk, the worst thing you think you can do is put a human being in the system. You want to remove the human being because they just slow things down. They just slow things down. And so the next crash is going to look much more like the flash crash than any of those other crashes, which were largely analog. 1987 was completely analog, even though it was in my lifetime. So I think a crash is actually unlikely. A real crash is actually unlikely. If you've seen me on CNBC, you know I'm not the world's biggest fan of the Federal Reserve's current interest rate regime. I think they're making some substantial mistakes, but I don't think it's likely to lead to a real crash. And that's a good thing, because crashes really undermine confidence in the market for a long, long, long time. Yes?
What are your thoughts on the rise in the last decade of ultra-passive investing, like just ETFs, mutual funds, and do you see any long-term implications of that trend?
Good question. So what about passive investing? That is indexing. Instead of some people in a room that are getting paid $1 million a year to pick stocks, what about just replicating, say, the S&P 500? You save the $1 million. You save the $1 million. And so you know you're going to track the market. You're giving up opportunity to beat the market, but you're also saving all this money. I think it's one of the great advances in investing, period. Over time, the S&P will beat about 75% of all the active managers. So some guy or girl is in a room picking stocks. I think this one's going to go higher. I think this one's going to go lower. Over time, indexers, passive investors, will beat those people about 75% of the time. You're thinking, well, I want to be one of the 25% that beats the market. Great idea. The problem is the people who beat the market, that group is different every year. So it's not, you can't say this person always beats the market. So I want to invest with them. Somebody like Warren Buffett, you might think, oh my God, look at all the money he's made. He's not an indexer. He's not a passive investor. Warren Buffett will tell you that he is an investor, but he'll also say his job is asset allocation. He's not really an investor as much as he runs a business. And much of the business he runs now is an insurance business. I mean, he loves the insurance business. He owns all of Geico. Why is that? Because it's a great business to be in. So I'm a huge fan of passive investing. I've never heard the term, you call it ultra passive? I think passive investing is a great idea. Over time, you will beat other people. You'll beat other investors. You may not beat the market, but you'll beat other investors. And let's look at it this way. Is your goal to have more money than everybody else or to be smarter than the market? I think your job should be to have more money than everybody else, because that's really what matters. If you have more money than everybody else, you can afford any home you want, any car you want, you can get anything, help your kids out with anything they want. If you're smarter than the market but have less money than anybody else in the world, what good does that do you? So I think it's a great thing. There are questions about whether or not indexing perverts the stock market. Okay, that's a great question. I don't think we're anywhere near seeing that. Pardon me, seeing that happen. The question becomes, well, what if it's all driven by indexing and there's no human being making a decision? Then again, does the market get perverted? I think that's a possibility. I think we're a long way away from that. And there are always people who won't buy the thesis of passive investing. So I think there will always be people who are trying to beat the market, and they should ease the concern that the market's going to be perverted by that.
We have time for one more question.
I was wondering where we were on time. Anybody else? Got to be one more.
One more.
All right, you're all done.
I got one for you.
Okay.
Are commissions dinosaurs, and what implications would that have for the market? I presume if you have a commission-free, environment, there's more trading.
The question is about commissions in executing stock trades and that sort of thing. I'm 55. When I was born, I obviously don't remember this. When I was born, commissions were set by the exchanges, and they were very high. That is, if you wanted to buy 100 shares of, then it would have been IBM. The exchange told you how much you had to charge your client or customer, and it was astronomical. We've now gotten to a point where through TD Ameritrade or E-Trade or Schwab, that commissions are a tiny fraction of the cost for an investor. For an investor, it's a tiny fraction of the cost. You can buy 1,000 shares of almost anything for $5. How much lower can it go? And I know the flip answer is it can go $5 lower, but I'm not certain that, I think we're probably at the point where going lower is diminishing returns. As an example, when I do CNBC, my sponsor is almost exclusively TD Ameritrade. So I don't have a relationship with them, but they sponsor a bunch of the shows. They spend a tremendous amount of time, money, and effort in education, in educating investors on what to do, how to do it, how to use some of these products. And so I think that they're really fulfilling a wonderful need through education, And J.J. Kinahan, who's become a good friend, says, our customers do what we teach, meaning if we teach a certain strategy, then they will see people start to use that strategy. And so they really evangelize about education for investors. I think that's fantastic. And if you don't charge any commission, you can't invest the money in education. So, okay. Sandy, are we done? Got to be done? Okay.
Scott, thank you.
Happy to do it. Thank you very much.